this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. So today's title is this just a head fake? Well, what am I talking about? Am I talking about basketball here? Although the head fake is one of my best moves. It's the only way I'm going to get a shot off. But no, I am talking about how the market has been very concentrated here over the last year or so, and maybe the other companies are going to start to do better. We started to see that this month. So is that for real, or is this just a head fake? So we're going to get into that and what this means for you. Let's get started. All right, so let's get started with the asset class returns for the month of March. So when we look at the blue bars here, that shows how the different asset classes did for March. And as you can see, they're all positive. Now, stocks did a little bit better than bonds, but generally up pretty nicely. We had a really great first quarter, one of the better quarters we've had in a while. We can also see the green bars here are showing the last 12 months have been very strong for the market. So very happy to report that. So a couple quick observations. You can see that large cap has been doing very well, up another 3+%, and that's mostly been large cap growth and really just a small amount of large cap tech stocks, which we're going to talk a little bit more about here in the update. But we're starting to see maybe small caps start to do a little better, up 3.24. We're starting to see developed international maybe start to do a little better. So we're maybe seeing a broadening of the market. So that's what we're going to talk more about in the outlook to see if that's for real. That's where the title comes in with the head fake. But you're seeing, even the fixed income market had a positive month. The more riskier parts of the bond market did better. But again, the big thing that happened last month was commodities. They stole the story for the month. They were up 4.2%, which is basically all the returns for the last 12 months. Basically happened last month. A lot of that was energy going up, but also precious metals. And so I am happy to report we do have exposure to gold, which definitely participated in that. All right, so let's get into the update. All right, so let's get started with the update. The first thing that I wanted to talk about was this market concentration issue that started in 2023 and has kind of continued in 2024, but it is starting to look a little different. So there's two things I wanted to show you here. First, on the left, you can see how the top 7 largest companies in the S&P 500 and what percent of the market of the S&P 500 they represent. And you can see like back here in 2015 or so, it represented, still a big part, but 14%. Where today it's 29%. This is the most top heavy the S&P 500 has been in 40 plus years. That's because those 7 stocks represent such a huge part of the market because they've done so well, okay? And then another way to look at this is to look at the performance last year. These are those top 7 stocks, which by the way, Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia. They were up 71% last year. The S&P 500 was up 19, which was a great year, but those 7 stocks alone were up 71%. That means that the rest of the 493 companies that make up the S&P 500 were only up 6. So if you didn't have exposure to those 7 names, you would have dramatically underperformed the S&P 500. And so what I'm trying to say here is that this doesn't continue on normally, and how much more can these stocks just continue to outperform everything else? Because they start getting pretty expensive. And so part of what I'm going to talk a little bit more in the outlook is maybe my thoughts of what I think could happen here going forward. Okay, there wouldn't be an update if I didn't talk about what's going on with inflation, because remember, inflation is what's driving the Fed, and the Fed has a huge impact on the stock market. And so let's talk about the Fed's favorite inflation metric, which is the PCE. Now this one comes out pretty late in the month, which is why I usually like to bring this one up, because it's pretty fresh data. But it is for the month of February. It's always kind of a month behind. And so that's why a lot of people look at the CPI, because the CPI comes out early in the month and it's kind of an indicator of what that PCE is going to look like. All right. But the PCE came out as 2.5% year over year. And that's basically the same as it was the prior month. So basically inflation just kind of was nice and flat. We were hoping to see a little bit more disinflation, but it basically stayed the same. Now, the other metric that the Fed looks at, which probably even more than the PCE, is the core PCE. This strips out energy, food, and these things that are very volatile. So when you look at this year over year, it was 2.8, which means it was down just a little bit. So that's a good sign, but it's still kind of stuck there. So the Fed is not super happy about this. The market's not super happy about this. It looks like we've done most of the easy disinflation, and we're kind of stuck in this kind of 2 to 3% range. And as you know, if you've been watching my videos, the Fed is trying to get down to 2%. So we'll see what happens next week. Next week's going to be the CPI report, and when you watch this video, it's going to probably be this week. And we'll see kind of where that PCE might be going next month. I do feel that we probably are kind of getting stuck here. It's getting a little harder because, and as you'll see here in a minute, the economy is hanging in there, still doing pretty good. All right, so I mentioned the economy is hanging in there, still doing pretty good. I'm actually a little surprised by this. If you've been watching my videos, you know I've been talking about the economy having maybe a 50-50 chance of going into a slowdown, maybe even a soft recession in 2024. Believe it or not, I'm starting to feel like maybe we actually could get this soft landing. This soft landing that last year pretty much nobody thought would happen is starting to have a higher and higher probability. And you're going to see in the outlook that I'm even starting to shift a little bit of the portfolio because of this. But here are some signs of what I'm talking about. The ISM Services PMI and the ISM Manufacturing PMI. These are the two biggest economic reports that come out that show the health of the economy. So services makes up 70% of our economy, is still growing. The March number was 51.4. Anything over 50 means the economy is growing. Now it did slow down a little bit, so that is somewhat concerning, but it's still in the growth category. And so when this number came out on Wednesday, the market actually had a pretty nice little jump because it showed services costs are coming down, which again, that's a good thing for inflation. The ISM Manufacturing, a little bit of the reverse. It was in a contraction, being under 50 last month, and now it's in positive growth. Now just barely, but we're finally in positive growth. So it seems like ISM Services was in this big, huge growth, and it's starting to slow down a little bit, and the manufacturing was slow, and it's starting to speed up a little bit. And maybe this is just a process of this post-pandemic world. Things got way off kiltered, and they're getting back to normal. So these are good signs, all right? Now, we also had the jobs report that just came out this morning as I record, and it was a gangbuster number. Again, we had over 300,000 jobs created in the month of March. Much more than it was expected. It was expected to be about 200,000. And we're seeing that hourly wages are going up nicely, but it wasn't super high. So it was actually, the market saw it as a good thing because they're seeing basically Goldilocks. We have all this growth in the economy, the labor market is strong, people are getting raises, but they're not getting too high of a raise, which would potentially create inflation. Now, raises are good. I'm not saying that raises are bad, but it can create a little vicious cycle with inflation. But it's going up enough that it's a good sign and not necessarily an inflationary sign. So here is my outlook. I believe that the global mood is shifting a little bit. And here are some of the reasons why I think this. Over the last year and a half, we've seen everybody raise rates. Well, there's a few exceptions, but most of the world has been raising rates, trying to head off inflation. We actually had the first central bank lower rates last week. And as you can see here by my picture, it was the Swiss National Bank. And I think this could be the beginning of a trend that we're going to see more and more. We're starting to see the European banks maybe also start to lower rates over the summer. You know, their economies are not super great. It's been slowing down, and their inflation has also been going down. And the Fed has reiterated many times that maybe in June they're going to be cutting rates. Now, they're not saying for sure. Of course, they're never going to say anything for sure, but it does look like they want to cut rates, and maybe 2 or 3 times this year starting in June. Now, here's the other point that I just don't believe the press, the business channels didn't pick this up. But when the Fed had their, they have their meeting in March, they said they weren't doing anything. They were going to keep rates the same. They did that again. But they've also been doing this thing called QT, which is quantitative tightening, where basically they've actually been letting their balance sheet roll off, which means that they're letting all the bonds that they own, that they bought back in the pandemic days, they're just letting them mature, and they're not buying them back. That's putting pressure on the bond market because there's less of buying of the bonds from the government. And so that's been making yields kind of creep up a little bit because there's less buyers. But one of the things that they mentioned during this meeting is that they may be slowing down this QT. Okay? This is huge. This is the first time they've mentioned this. Most of the media have not been talking about this. But I feel like, to me, that is a big sign that the Fed thinks that, well, either they think that maybe things are going to get a lot worse and they're not letting everybody know, and that's a possibility, although I don't think that based on what I've talked about so far. I think they're seeing that inflation is coming down, and they feel a little bit more confident about that, although they're not quite ready to do that, but they're starting to signal that. And again, that is a big shift in what the Fed has been doing over the last couple years. And my last thing, and I've been harping on this for a few months now, the 4 pillars. I added one, an extra one, which is AI. The 4 pillars are holding up pretty good. Growth has been steady. You saw that in the update when I was talking about the ISM numbers. Disinflation continues. Now, it's going painfully slow. We'd like for it to go faster, but it doesn't look like it's going to bump up. And if it does, it's going to hopefully be a short-term thing. But that continues to be in play. Earnings slowly improving. We're starting to see that earnings kind of bottomed out last year, and they're starting to slowly improve. And the AI hope remains. Of course, that's going to bring a little momentum, a little excitement into the market as we think about what we could potentially do with all these cool computer AI gadgets to help us be more productive. So all these things are still holding strong. All right, last thing for the Heartwood implications. What does this all mean based on what's going on and my outlook? Here are some of the shifts that I'm starting to make in the portfolios. First of all, in stocks, I am bumping up the stock allocation a little bit, going into a slightly bullish stance with the portfolio, weighting a little bit more to stocks, particularly adding to large cap value. Remember the other 493 stocks that way underperformed over the last year or so because the large cap tech has done so well? Well, I'm going to start to add a little bit more to that other 493 because I think if the economy continues to stay pretty healthy, those other 493 companies are going to start to do better, along with also the small and mid-cap U.S. companies. I'm not quite ready to jump into higher international holdings but I am ready to maybe start legging in a little bit more into the small and mid caps from the US. So where is this coming from? It's coming from trimming down a little bit in bonds, especially the longer duration, because if the economy is doing good, inflation is going to kind of hang in there a little longer. So that means the Fed is going to try to cut rates, but they won't be able to do many cuts, which is going to keep the bonds from appreciating too much. So in the meantime, I want to take advantage of this economy as it's hanging in there and have a little bit more exposure in the equities. And I'm also taking a little bit that from the cash as we generate those extra dividends from the nice cash yields and all the dividends that are coming from stocks, and we reinvest it. Okay? So hopefully that makes sense. Please reach out if you have any questions, but we're getting a little bit more bullish. This is a big change because I've been neutral for probably about a year. All right. Thanks for watching, guys, and God bless.